Hello and welcome to 7 Startups educational video series. Today we'll see whether your startup is VC fundable. Not getting funding from VCs can be frustrating for startups, especially if you have a strong product, business model, team, and potentially even profits. However, this lack of interest from investors could be due to a misunderstanding of what VCs are actually looking for. Not all startups are suited for VC funding, and it's important to understand the VC model and what they seek in early-stage companies. If your startup does not fit the VC prototype, there are alternative options to consider. We'll show first how VCs make money, and we'll show you what VCs look for in early-stage companies apart from unicorns. We've split this section into three: people, product, and market. Following, we'll talk about who doesn't fit the VC mold and funding for alternative ventures. VC funds often raise money for new funds every 3 to 5 years if they can. Although making a lot of money on many deals may seem like a good outcome, the VC model relies on a few select deals bringing in extremely high returns. For example, a £50 million fund will typically allocate £20 million for initial investments, £20 million for follow-on investments, and £10 million for management fees. Returns come from successful liquidity events, like acquisitions or IPOs. However, building a successful startup is difficult, and most never reach an exit, so the VC model follows a power law distribution where a small percentage of startups bring a large percentage of returns. The outliers, known as fund returners, make up for the losses of other investments in the portfolio. Hence, the startup ecosystem is focused on unicorns valued at over £1 billion, as these companies hold the potential to become the fund returners that VC firms need to survive. What are VCs looking for in early-stage companies? VC funding is governed by the power law, which states that a few startups bring in the majority of returns. So, most VCs look for startups with the potential to become a unicorn and make a huge impact. In order to secure VC funding, startups not only need to present a large market opportunity but also convince investors that they are the right team to seize that opportunity. VCs use heuristics to evaluate investment prospects, primarily evaluating the people behind the startup, the product, and the market. Having confidence in the potential of your business to reach billion-pound success is crucial, but this alone is not enough to make it a reality. Investors seek out individuals who possess a unique combination of ambition, determination, and the ability to overcome challenges, characterized as being smart enough to succeed and daring enough to try. VC firms often have their own frameworks for evaluating the potential of founders, so the specific combination of traits may vary depending on the firm. In reality, startups don't always follow the romanticized notion of a founder having a billion-dollar idea and making it big. Founders often need to pivot from their original idea multiple times before finding a suitable product-market fit. It's the team's ability to work together to execute the vision that ultimately matters. VCs look for a diverse team with complementary strengths and weaknesses and a joint commitment to the company's vision. They also consider the founding team's past experiences, including work experience that demonstrates their readiness to tackle the problem and outstanding abilities, or a hacker mentality. VCs also assess the founder market fit, FMF, which refers to the founder's deep understanding of the market and high level of personal motivation to solve the problem in that market. A cap table outlines the ownership structure of a company, showing the proportion of each class of shares owned by each shareholder. Investors prefer a well-organized cap table, with a limited number of shareholders and a straightforward ownership structure. This allows for clear value adding, with no overly large share allocation for advisors or early investors, and no hindrance from former founders. A clean cap table also facilitates communication and voting. Founders should carefully consider who to include on the cap table, as being on the table means having decision-making power. An ill-fitting investor can cause many problems for the company. Investors also look for operational founders to have a significant share of ownership to ensure their long-term motivation in building the company. This often translates to founders owning at least 50% of the total equity when the company grows. This helps ensure that they remain motivated and committed during the challenging early stages of the venture, which can last for a decade or more. It's crucial to have a solid idea or problem space to work on. In order to have a successful and disruptive startup, it's ideal for the founders to have a personal connection or experience with the problem they aim to solve. This can ensure they have the passion and perseverance to overcome challenges along the way. VCs are often drawn to startups that have a natural pull towards a problem, and a personal backstory adds to the narrative for both customers and investors. However, if the problem doesn't fit these criteria, it may be necessary to have a deeper understanding of the industry and a convincing argument for why the problem is significant and why the team is the best one to solve it. Demonstrating proof of concept, such as a sample or market testing, can show the potential for the idea to be realized. However, this does not necessarily mean there is already market demand, which is where traction comes in. Early customer traction is a crucial factor in attracting investment for a startup. It's a measure of validation that the startup has received initial interest and people are actively using the product. Traction can be shown through metrics such as revenue, daily active users, or relevant metrics specific to the startup sector. Growth is a crucial aspect that investors consider when evaluating a startup. The focus of growth varies depending on the industry and business model. For instance, in B2C companies, the emphasis is on user engagement and retention, while in B2B companies, growth is a key metric once the company reaches $1 million in annual recurring revenue, ARR. A typical growth range for B2B companies is between 15% to 25%. However, growth can be demonstrated through various metrics such as waitlisted users, low customer acquisition cost, CAC, low churn rate, and other factors that impact long-term growth. The total addressable market, TAM, is another crucial aspect for VCs to consider when evaluating investment opportunities. It refers to the maximum size of the business opportunity and is often used as a proxy for the potential revenue of a company. Larger TAMs are generally seen as having more potential for growth, but smaller TAMs can also produce successful companies. VCs look at TAM assessments, especially in the early stages, as a way to gauge whether the company is targeting a large enough market and has a realistic plan for capturing a significant portion of that market. A company's TAM can be estimated based on factors such as its target market size, market share, and market growth rate. When it comes to early-stage startups raising pre-seed or seed funding, VCs primarily focus on TAM and other attributes such as traction and growth. Pre-seed funding is meant to demonstrate market need, while seed funding is used to prove market fit. Who doesn't fit the VC mold? VC funding is optimized for startups that have certain characteristics, such as the ability to scale quickly, to go through fast iteration cycles, and generate recurring revenue with low marginal costs, which is typically true for software startups. On the other hand, deep tech, service businesses, and hardware companies may not attract funding from traditional VCs because they may have longer timelines for scaling, smaller target markets, or rely heavily on labor. These types of companies, despite having a scalable business, may not align with the VC cycle. There are also companies that meet the criteria of a startup but don't aim for high enough or fast enough growth to attract VC funding. VCs expect the risk involved in investing in deep tech and hardware startups to be offset by large, obvious, and broad markets, and rewards are in order of magnitude greater than the risk. They look for startups that have a hyper-focus on one initial use case and can scale broadly, capturing the significant value that aligns with the risk and capital requirements to develop the technology. Funding for alternative ventures. Startups that are not suitable for VC funding have other sources of financing available. These include angel investors, individuals who provide early-stage capital to startups or bootstrapping through the use of company revenue, personal savings, or debt, corporate venture capital from big corporations, family offices that help wealthy families invest their money, friends and family rounds, government grants and subsidies, revenue-based financing that involves paying off a loan from an investor with generated revenue, and venture debt, which is a type of loan financing used to provide funding between equity rounds or for acquisitions. VC funding may not be suitable for every startup, and it's important to understand what VCs are looking for to determine if it's the right fit. Companies that do not meet the typical goals, timeline, and scale favored by VCs may need to consider alternative funding options. Check out our website if you'd like to know more about 7startup, and be sure to watch the rest of our educational videos. Thank you for watching.